The Institute greatly values our long-standing relationship with the New York Fed, and we're very grateful to Bill for joining us today. Ladies and gentlemen, please give him a warm welcome.
Thank you, Waldo, and I want to thank the IIB and for all of you coming here today to hear me speak. It's a real pleasure to have the opportunity to discuss the challenges ahead in making the banking system and the financial system more resilient and robust. We have learned a great deal over the past 2 years about our financial system and its vulnerabilities. The challenge ahead is to put these lessons to good use. Regulators and market participants fail to fully appreciate the degree to which various aspects of our financial system are interconnected, and to foresee what those tight linkages would mean for market function when even one reasonably large institution, let alone many, became distressed. We also did not fully appreciate the strength of the amplifying mechanisms that were built into our financial system, the consequence of which was to exacerbate the boom on the way up and to worsen the bust on the way down. Contributing to these pro-cyclical dynamics were inadequate incentives for firms to curb their risk-taking and to more effectively managing the risks they did face. The inadequate level of transparency and disclosure, particularly in the market for structured products, were also important in making the financial system more fragile and vulnerable to crisis, and in increasing the degree of uncertainty and contagions once the crisis got underway. Only by fully understanding these shortcomings can we construct solutions that will strengthen our financial system and make it more robust. The initiatives underway to strengthen our financial system span a wide range of supervisory and regulatory policy areas, including ongoing efforts to improve standards for both the capital and liquidity held by financial institutions, efforts to improve the risk management practices at financial institutions, and efforts to strengthen the resiliency of market infrastructures. Today I'm going to focus mainly on the need to improve the capital standards for large, systemically important financial institutions. For initiatives in this area to be effective, we need to make progress, I think, on three distinct but related fronts. First, more thorough and complete risk capture so that the capital adequacy rules more effectively encompass a broader set of risk exposures than before. Second, rules that encourage the conservation of capital in adverse economic and financial circumstances. And third, tougher regulatory requirements, including the use of a contingent capital instrument that would automatically replenish equity capital in times of stress. As always, my remarks reflect my own views and opinions and not necessarily those of the Federal Open Market Committee or the Federal Reserve System. So turning first to the issue of interconnectedness, this financial crisis has exposed how important the interconnections are among the banking system, capital markets, and payment and settlement systems. For example, the recent disruption in the functioning of the securitization market caused by the poor performance, maybe horrible performance, of some highly rated debt securities led to significant problems for major financial institutions. Banks had to take assets back on their books, backstop lines of credit were triggered, banks could no longer securitize loans, which increased the pressure on their balance sheets. This in turn reduced credit availability, which increased the downward pressure on economic activity, which caused asset values to decline further, increasing the degree of stress in the financial system. This interconnectedness implies that regulation and risk management practices that focus only on individual parts of the system will inevitably fail to address important vulnerabilities that lie elsewhere. Thus, we have to make widespread changes in how we approach supervision and regulation, particularly in the context of our most important, systemically important financial institutions. First, although supervision cannot lose its vertical perspective, looking firm by firm or region by region, it also must place more emphasis than before on gaining a horizontal perspective, looking broadly across banks, securities firms, and other types of financial institutions, and across markets and geographies. Second, the supervision of our financial institutions and the regulation of markets needs to be risk-focused, coordinated, and multidisciplinary. In thinking about the best way to introduce these practices into our system, we should not kid ourselves about how difficult this is going to be to execute. We'll take the right people with the right skill sets, operating in a system with the right culture, tools, and legal framework. The governance process surrounding systemic risk regulation will have to be extremely flexible and dynamic, able to identify important vulnerabilities as they emerge, and able to act on those concerns in a timely manner. Turning now to system dynamics. Over the course of this crisis, it has been evident that our system had some powerful reinforcing mechanisms built into it. This suggests that one important focus of regulation should be on how to change the system in order to eliminate or at least mitigate these destructive dynamics. Let me give you a few examples. In times of stress, banks may have incentives to continue to pay dividends to show they are strong even when they are not. This behavior depletes the bank's capital and makes the bank weaker. To correct this shortcoming in our system, we should craft policies that either incent or require weak and vulnerable firms to cut dividends quickly in order to conserve capital. If we did this, that would introduce a dampening mechanism into our system. Another example of a reinforcing mechanism is the situation in which firms have incentives to structure activities to minimize regulatory capital or other requirements without transferring risk. Creation of off-balance sheet funding vehicles, structured products, and complex corporate structures to minimize regulatory requirements and tax obligations reduces transparency, introduces new risks, and limits the effectiveness of resolution regimes. Other examples of reinforcing mechanisms in our system include collateral tied to credit ratings. Credit downgrades lead to increased collateral calls, which drain liquidity, forcing asset sales. Those asset sales further weaken the firm, subject to the collateral calls. Collateral and haircuts. When volatility rises, that leads to increased haircuts. The result can be a vicious cycle of forced asset sales, higher volatility, and still higher haircuts. Compensation tied to short-term revenue generation rather than long-term profitability over the cycle. This causes risk takers to take too much risk because they are compensated on the upside. This risk-taking extends the boom, setting the stage for a bigger bust. Although some of these practices might appear sensible from the narrow perspective of an individual firm or market, this crisis has shown us that when all firms or all market participants simultaneously take an action that appears to be in their immediate narrow interest, the collective impact on the entire system as a whole can be disastrous. We need to find ways to weaken or eliminate these reinforcing mechanisms, and we need to introduce new dampening mechanisms into the financial system. Turning now to incentives. Some of the pro-cyclical dynamics embedded in our financial system occur because market participants do not always have the incentive to behave in ways that will be good for the system as a whole. This occurs in part because market participants often do not have to bear the full costs of their actions. For example, the incentive to take on more risk without regard for the broader implications of those actions arises from a number of factors, including poorly constructed compensation schemes, ineffective risk management, and gaps in regulatory oversight and risk capture. One problem evident during the crisis has been the reluctance of banking organizations to raise sufficient capital to be able to credibly have the resources to withstand particularly adverse economic conditions. This reluctance stemmed in part from concerns about what a capital raise would signal about a firm's strength, but it also stemmed from an unwillingness to unnecessarily dilute shareholders. The reluctance led to more uncertainty about the adequacy of banks' capital positions, which in turn increased concerns about counterparty credit risks. These worries led to further deterioration in market liquidity. These dynamics tightened financial market and credit conditions, increasing the downward pressure on economic activity and on the financial system. The Supervisory Capital Assessment Program, or SCAP exercise that we undertook in the United States, tried to lean against this by forcing all the banks that participated in the SCAP exercise to have sufficient capital to help them withstand a stress environment. This process improved confidence and increased the willingness of banks to engage with each other. It also made it easier for the banks to be able to tap the capital markets. The SCAP exercise made a bad state of the world less likely, helping to create a virtuous circle rather than a vicious one. The SCAP exercise was developed and conducted in response to the crisis and the specific need. Now we need to figure out how to conduct these type of exercises on an ongoing and systematic basis. Such exercises may even need to be hardwired into the supervisory oversight of the financial system. Turning now to transparency. In some critical segments of our financial markets, both before and during the crisis, limited or ineffective disclosure undermined market discipline, and this contributed to the accumulation of risk. In the years leading up to the crisis, the lack of transparency contributed to increased risk in leverage in off-balance sheet vehicles, structured credit products, and in over-the-counter securities such as asset-backed securities, commercial mortgage-backed securities, residential mortgage-backed securities, and collateralized debt obligation, or CDOs, and their associated derivatives. Once the crisis was underway, the opacity of many of these vehicles, structures, and securities contributed to the concerns about counterparty credit risk. This uncertainty exacerbated the erosion in market liquidity conditions and further intensified the crisis. This lack of transparency was present in a number of different places. First, valuation. CDOs and other securitized obligations were complex and difficult to value. This reduced liquidity, pushed down prices, and increased uncertainty about the solvency of those institutions that were holding those assets. Prices. The lack of pricing information led to a loss of confidence about accounting marks. Sometimes identical securities were valued differently at different financial institutions, sometimes with the same accounting firm. Concentration of risk. Because there was no detailed reporting of exposures, market participants did not know much about the concentration of risk. This led to a reluctance to engage with counterparties, which in turn pushed up spreads and reduced liquidity further. These four strands, understanding interconnectedness, mitigating pro-cyclical system dynamics, improving incentives, and increasing transparency, should be critical areas of focus in our efforts to enhance the resiliency of the banking and financial system. We will need to do this through several channels, including international regulatory reform, enhanced capital requirements, the introduction of common liquidity standards, and clear expectations for compensation practices. Today I'm going to spend some time talking about how we might take account of these strands to ensure that our regulatory capital regime helps to facilitate a more robust and stable financial system. In my view, the regulatory capital framework would benefit from four changes. First, improving the risk capture associated with the capital requirements. Second, introduction of rules that ensure the conservation of capital during times of economic and financial distress. Third, imposition of higher capital requirements for systemically important institutions. And fourth, development of efficient forms of capital, in particular, contingent capital instruments that are convertible into common equity if a bank's share price were to fall precipitously. Turning first to capital requirements with improved risk capture. The recent financial crisis has shown that parts of the regulatory capital framework were not calibrated properly to account for the most complex instruments. Our efforts to revise the capital rules should emphasize the need to include these and other risks that were not appropriately captured in recent years. In many circumstances, an emphasis on improved risk capture may be superior to simply raising the capital requirements across the board. There are two reasons for this. First, improving risk capture may better tie capital to the risk being undertaken. This in turn would create more appropriate incentives for risk-taking. Second, it may reduce the risk of regulatory arbitrage. If the risks of some activities are not captured properly, then banks will have incentives to shift their business towards those particular activities. The Basel Committee has made very good progress in revising the capital treatment of trading book positions and for structured credit products, two areas where the crisis revealed critical weaknesses in the regulatory capital regime. Revisions to the capital requirements for over-the-counter derivative exposures as proposed by the Obama administration also strike me as broadly appropriate. Not only would this effectively capture the risks that banks are taking, but it would also create incentives to move the trading and settlement of such instruments more rapidly to central clearing partners, or CCPs, and to exchanges. The greater use of CCPs and exchanges in turn would have several benefits, including reduction of risks through the multilateral netting of exposures and improved transparency with respect to the structure and pricing for such instruments. Turning now to capital conservation. More explicit supervisory standards regarding capital conservation would also be an important element of an efficient capital regime. During the crisis, some banks continued to pay out dividends even though their condition and market valuation metrics had sharply deteriorated. Banks did this to try to convince investors that their bank was sound. But by depleting capital, these actions made those banks and the financial system weaker. To mitigate these dynamics, regulators could require the reduction and possibly the cessation of dividend payments and share buybacks during adverse market environments when particular triggers were breached. For example, limits on dividend payments and share repurchases as a share of earnings could be mandated to occur when common equity ratios fell below certain levels, recognizing that credit and mark-to-market losses deplete the capital structure from below, or when market-based measures hit certain trigger values. Taking away the discretion of banks to deplete capital would strengthen banks' ability to withstand adverse environments. In principle, such constraints could conceivably even be extended to compensation and bonus payments. Some of the firms that encountered difficulty in 2008 paid out large bonuses early in 2008 despite the deterioration in market conditions and their own financial performance. There is an opportunity to rethink capital preservation policies to ensure that banks' incentives are consistent with the supervisory objectives of a safe and sound banking system. Such capital conservations could operate on both sides of an economic downturn, conserving capital going into the downturn and rebuilding capital coming out. One example would be the imposition of constraints on the ability of banks to reinstate or increase dividends prematurely or undertake share buybacks during a downturn or during the early stages of an economic recovery. Turning now to higher capital requirements for systemically important institutions. Currently, some large systemically important institutions may have a competitive advantage because they are perceived to be, quote, too big to fail, unquote. Unless we address this disparity, we will have an ongoing moral hazard problem and inevitable market structure distortions as firms take steps to become systemically important in order to gain a competitive advantage. The regulatory regime could lean against this in two ways. First, we could improve the resolution mechanisms for large, complex institutions and thereby reduce the costs associated with failure. A more robust resolution regime would make it more feasible to allow the failure of a large financial institution without that failure threatening the stability of the entire financial system. Second, we can impose higher capital requirements on large systemically important institutions to offset the advantages such as lower funding costs that these institutions may garner by their perceived, quote, too big to fail, unquote, status. This would recognize the interconnectedness of the financial system and the fact that the failure of a systemically important institution generates significant externalities which are not at present borne fully by the equity and debt holders of such institutions. Increasing the size of the capital buffer would make the system more stable by reducing the incentive for firms to get big just to capture the perceived benefits from achieving too big to fail status. Now, the first change, an improved resolution mechanism, would presumably reduce the number of institutions at any point in time would be systemically important. The second change, the imposition of higher capital requirements on large systemically important institutions, would reduce the likelihood of failure of such institutions. However, in assessing the efficacy of such changes, we need to be realistic about the difficulties in building a resolution mechanism that would be sufficiently robust to allow the failure of any institution under any circumstance, and in designing a capital regime that imposes differential requirements on large systemically important institutions. This is not easy. On the resolution regime side of the ledger, it's particularly difficult to build resolution regimes that can operate effectively across different geographic jurisdictions. Legal regimes are different, national authorities have different incentives, and coordinating resolution across multiple geographies in a way that treats counterparties in different jurisdictions equivalently would be a daunting mission. Similarly, designing an effective capital surcharge for systemically important institutions will also be very challenging. Broadly, there are two approaches. One, we could either require a set of firms identified to be systemically important to hold additional capital, or two, we could introduce a capital surcharge for firms that was linked to measures of systemic risk. In broad terms, the factors that could be used to identify systemically important financial institutions would be related to a firm's interdependence with the financial system and the impact on market confidence should the firm be distressed. Measures of size, leverage, liability structure, and the importance in the credit formation and liquidity provision could all be indicators of systemic importance. Developing a consistent objective set of measures either to size a capital surcharge or identify such firms is particularly difficult. For example, introducing a single measure to size a capital surcharge, such as firm size, may create arbitrage opportunities and will almost certainly not capture the full extent that any individual firm may contribute to systemic risk. Moreover, identifying a set of systemically important institutions may reinforce concerns about moral hazard. We also have the difficulty that the particular metrics used to determine which firms are systemically important are likely to change over time with changes in market structure and as particular financial institutions evolve in terms of their structure and performance. Turning now to contingent capital. An ideal capital requirement regime should be efficient and should create the proper incentives for banking organizations to internalize the cost of their actions on the broader financial system and macroeconomy. Efficiency, which I'll define here as minimizing the amount and cost of capital needed to ensure solvency under adverse conditions, is important because an inefficient system will inevitably encourage growth and activity outside the regulatory regime and will likely drive up the overall cost of intermediation. Proper incentives are needed to control risk and better align the interests of management and shareholders with those of the public. In both respects, the introduction of contingent capital instruments seems likely to hold real promise. Relative to simply raising capital requirements, contingent capital has the potential to be more efficient because the capital arrives as equity only in bad states of the world when it is needed. It also has the benefit of improving incentives by creating two-way risks for bank managements and shareholders. If the bank encounters difficulty triggering conversion, shareholders would be automatically and immediately diluted. This would create strong incentives for bank managements to manage not only for good outcomes on the upside of the boom, but also against bad outcomes on the downside. Conceptually, contingent capital instruments would be debt instruments in good states of the world, but would convert into common equity at pre-specified trigger levels in bad states of the world. In principle, these triggers could be tied to deterioration in the condition of a specific banking institution and or to the banking system as a whole. Now, there are many issues that would have to be worked out regarding how best to design such instruments, including how to determine their share of total capital, as well as how to configure and publicly disclose the conversion terms and triggers. But in my view, allowing firms to issue contingent capital instruments that would be used to augment their common equity capital during a downturn may be a more straightforward and efficient way to achieve a counter-cyclical regulatory capital regime compared to trying to structure minimum regulatory capital requirements or capital buffers above those requirements that decline as conditions in the financial sector worsen. So what might such a contingent capital instrument look like? Well, one possibility is a debt instrument that is convertible into common shares if and only if the performance of the bank deteriorates sharply. While in principle this could be tied solely to regulatory measures of capital, it might work better if it was tied to market-based measures because market-based measures tend to lead regulatory-based measures. Also, if it was tied to market-based measures, there would be greater scope for adjustment of the conversion terms in a way to make the instruments more attractive to investors. And hence, this would lower the cost of these capital instruments to the issuer. The conversion terms could be generous to the holder of the contingent capital instrument. For example, one might want to set the conversion terms so that the debt holders could expect to get out whole or close to whole, in other words, at par value. This is important because it would reduce the cost of the contingent instrument, making it a considerably cheaper form of capital than common equity. Consider the advantages that such an instrument would have had during this crisis. Rather than banks clumsily evaluating whether to cut dividends raise common equity and/or conduct exchanges of common equity for preferred shares, and market participants uncertain about the willingness and ability of firms to complete such transactions and successfully raise new capital, contingent capital would have been converted automatically into common equity when market triggers were hit. If these contingent capital buffers were large, which they could be because the cost of these instruments should not differ much from straight debt, then the worst aspects of the banking crisis might have been averted. If shareholders had faced the potential of automatic and substantial dilution, they may have demanded better risk management and disclosure during the boom. If common equity had been automatically bolstered during the early part of the crisis, investors would have been much less concerned about the risk of insolvency. Counterparty risk concerns would have been much less significant, potentially short-circuiting one of the important amplifying mechanisms of the crisis. Such instruments would have reduced the likelihood of failure of large systemically important institutions, reducing the significance of the too-big-to-fail problem and its associated moral hazard problems. Now I want to turn to talking about harmonized standard. The Financial Stability Board and the Basel Committee are working hard and are making important progress on all these issues. But for these issues to bear fruit, it's critical that the requirements that are imposed in terms of capital adequacy, liquidity, and compensation be harmonized across regulatory regimes and applied in a consistent fashion. The absence of a level playing field would be a recipe for disaster. A lack of harmonized standards would inevitably lead to balkanization and protectionism as different countries took steps to protect their particular banking champions. Potentially, this could lead to countries requiring capital and liquidity to be segregated locally. This would have a number of negative consequences. First and foremost, it could disrupt the ability of capital to flow freely across borders, interfering and inhibiting globalization in terms of financial intermediation. Second, it would reduce the diversification benefits that stem from banks that operate in different geographic locations. And third, it could undermine the safety and soundness of the financial system. In particular, the lack of harmonization in terms of regulatory regimes could lead to a race to the bottom, as firms and businesses migrated as much as business as possible to the most lax regulatory regime. So what does this mean for the audience today, foreign banks operating in the U.S.? First, these institutions should not expect a return to, quote, business as usual, unquote. We are committed to implementing the reforms that will prevent a recurrence of the recent financial crisis. Second, as most of the current reform agenda of the Financial Stability Board and the Basel Committee relates to the regulatory framework as applied to your home country, we expect foreign banks' operations in the United States will fully comply with these structures as they are put in their home country as well. Third, we support the continued international banking presence of global banking institutions. National implementation must not jeopardize the economic benefits derived from cross-border banking. We need to be wary about nationalistic approaches to supervision. Fourth, financial firms that operate in our market should continue to be vigilant in meeting the expectations we have for strong risk management and compliance practices. Wasn't too long ago that some foreign banking organizations faced supervisory discipline for failing to meet these standards. Given the lessons of the crisis, I would expect our focus and attention on these areas would only intensify going forward. Fifth, we will be particularly focused on how the new supervisory framework will apply to the U.S. personnel associated with the operations of foreign banks in the United States. In particular, we will have substantial concern if these firms' compensation practices are contrary to the text or the spirit of the international agreements on compensation practices that are in the process of being hammered out. For example, multi-year guaranteed bonus payments would raise a red flag for us, as they are not likely to be consistent with the evolving consensus on sound compensation practices. Thank you for your kind attention. I would be very happy to take a few questions. Questions? The floor is open.
You've given probably the most complete discussion of contingent capital ideas that I've heard, at least. One of these things that's floating around in the discourse but isn't really very developed yet. and it's encouraging perhaps in many ways. But if that is an alternative to the equally rather vague concept of buffers that's also floating around, is there time, given the G20 timeline, to develop that kind of idea that might work in lieu of buffers?
Contingent capital is definitely part of the conversation. I think Governor Trullo mentioned it in his testimony. Basel Committee has that on their agenda. We have to figure out the best way to get where we want to go. Maybe it's buffers, maybe it's contingent capital, maybe it's a mixture of the two. I think the thing that I want to emphasize today is that efficiency of capital is also important, and we have to recognize that if we were to raise the capital requirements too high, whatever too high is, that would have consequences that also have to be taken into consideration. Now, do I think that we're in danger of raising the capital requirements too high given the financial crisis that we've just seen? That doesn't seem to be something, that's not something I go to sleep about, worrying about. And I think it depends on what country and regime we're talking about. I think if you look at the amount of common equity that U.S. banking organizations have, they have quite a bit of very high quality capital relative to some other areas.
Absent from your comments was any discussion of leverage caps. How does that play into the analysis regarding capital and other things to do in the system?
Well, there's very definitely discussion about the notion of having an overall leverage ratio. You can sort of think of it as a belt and suspenders to prevent people from going around the risk-based capital requirements. And I think it's certainly something to think very hard about. If you look at countries like Canada that did have an overall leverage ratio, their banks came through the crisis virtually unscathed. Now, I'm not saying that the leverage ratio was the only reason for that, but there is at least some evidence that the leverage ratio would have prevented some of the really extreme degrees of leverage that we saw for certain financial institutions. Now, obviously, improved risk capture will also move you in the same direction. So it's not, the improved risk capture and leverage ratio, overall leverage ratio requirements in some ways are, substitutes. But you may also want to have that set of suspenders just to make sure that you have covered the waterfront and you haven't left any loopholes that banking organizations might try to utilize.
I thought you had a lot of great ideas there. One thing I want to ask you about is the too big to fail issue, because I think when I heard the section on resolution regimes, that seemed very realistic to me. Which then, for reading between the lines, the too big to fail solution is we take the failure probability to 0 for the largest institutions. Is that the only policy idea that we have, and is that realistic that we can ever, through any combination of measures, take it to 0 forever?
I don't think it's realistic to think that one could take the probability of failure to 0. Obviously, I can't foresee what kind of economic environments and financial environments that might, occur in any conceivable state of nature. So I think it's not practical. What you want to do is take the probability of failure down to a low enough level so that moral hazard is not a huge problem in terms of large systemically important institutions getting a perceived advantage. And two, to the extent there is a residual risk of failure, you want those institutions to have to essentially internalize those costs. So you want some way of forcing those institutions to internalize whatever that modest residual probability of failure is left. That's why I think it's really both together. Improve resolution mechanisms so the number of firms that are systemically important that you maybe can't allow to fail in certain environments is reduced. You want to do that as much as possible. In an ideal world, it would be great if we could have any institution fail under any conceivable state of the world. I don't think that's practical. And then second, if there is a failure, you want to make it so that the probability of that happening is pretty darn low. And obviously, where to set that line precisely, it's hard to know. That's a judgment call. I think the important thing, though, is if you're providing an advantage to institutions by having a perceived or real advantage of being too big to fail, then those institutions have to internalize the cost of that advantage. Otherwise, you're going to generate a whole set of bad behaviors that you don't want to encourage. Larry.
Bill, I think everyone in this room applauds your case for harmonized regulation, particularly for cross-border systemic institutions. But I would raise the question if you could comment on proposals that would create some sort of a systemic council and how well it could deal with the need for harmonized regulation and the heavy operational umbrella supervisory role that's currently undertaken by the Fed and other regulators.
I think Larry, to your question, I think the problem on harmonization is not really sort of a U.S. problem, the fact that we have a bunch of different banking regulators. I think the harmonization issue is really what are the rules and standards in the U.S. versus the rules and standards elsewhere. I think that we can harmonize regulation in the U.S. pretty easily, and I think there's good communication between the different banking regulators. So I don't think that's such a problem. I think the challenge is across sovereignties, and I think that's more difficult. I mean, I think that the Financial Stability Board has made quite a bit of progress in bringing a lot of countries along together, and the challenge is to keep that convoy moving forward, and that's what we're going to try to do over the next coming months.